So today's agenda, going over the general approach, kind of the basic theory behind how to determine how much is an ideal amount to borrow, an amount that is both approvable by a lender, but also gives you the business owner or gives the business enough capital to grow. And then we'll walk through a worksheet calculator that I developed to help do all the math so you can easily figure out what might be an ideal amount to ask for a business loan. And then we'll talk quickly about business advising and then wrap up with any Q&A. And my hope is to kind of wrap this up by 12:45 so that it will be kind of a quick lunch and learn for everybody. So with that, I used to be a lender, and when people come up to me and approach me for a loan, the absolute worst answer a business owner can give to a lender when the lender asks you how much money you need is, "I'll take whatever you can give me." And you'll be surprised that I got that response many times, probably almost on a 50-50 basis. They would just say, "I'll take whatever you can give me." And that's the absolute worst answer you can give to a lender, because it immediately demonstrates two things. One is that there is no or poor, financial planning on behalf of the business owner around the loan, and in terms of what they'll use the money for, as well as how they plan on repaying the loan. It also demonstrates that there isn't really a repayment mindset, that they're just going to take the money and run with it, and maybe they're not going to kind of run away with it, but there isn't, when you say, "I'll take whatever you can give me," there's no mindset that's around repaying the loan. So that is the absolute worst answer. Do not give that answer to any lender. Chances of having a follow-up conversation is going to be relatively small unless you come back and do your homework. So let's go back to what repays a loan. Profits are what repays loans. You make an investment, you start generating revenue. Hopefully that revenue is more than your expenses, and you generate profits. Profits to cover your expenses, profits after any income or business returns that you get. Profits are what repays the loan ultimately. And so on this graph here, we see, on one axis profits and one axis is borrowed capital. And if you pick an amount, I'm just going to pick this amount here where the cursor is at. If you pick this amount, if you don't generate sufficient profits, if you're in this range here, you're not going to have enough profits to repay the loan. But the more profits you are able to generate, then you start entering a zone where you will have sufficient profits to repay the loan. And so at that point, the loan becomes more and more approvable. So the more profits you have, the more approvable your loan will be. And the math behind all this is a ratio that lenders often use called the debt service coverage ratio. Sounds complicated, but really what it is it's your total annual profits divided by your total annual loan payments. And if that ratio is less than 1, that means your profits or your free cash flow is less than your loan payments. Whereas if that ratio is greater than 1, meaning that your annual profits are greater than your total annual loan payments, your profits will be greater than your loan payments. And so the debt service coverage ratio is a really easy back of the envelope calculation that a lender will look at, when they first start talking to you about a loan, and they'll be able to give you a gut reaction as to whether a loan is possible or not. It's relatively easy to calculate. The concept is pretty simple, and it basically says, is there enough cash to repay the loan? So if we go back to the chart that I showed before and break it down a little bit, you're the same chart, but now I break the debt service coverage ratio or this chart into different zones of debt service coverage ratio. The original line that you saw there had a debt service coverage ratio of 1. So that's the top line here. And so anything where the debt service coverage ratio is less than 1, it's not lendable. You know, no matter how enthusiastic or how wonderful your product is, you're not going to generate enough profits to or free cash flow to repay the loan. So it absolutely has to be greater than 1. Then there is this debt service coverage ratio that's, you know, a little bit more aggressive. It comes in at 1.2. And, you know, between 1 and 1.2, that's where a community lender, you know, like a Craft 3, like a MISO, like a Business Impact Northwest, you know, these are typically nonprofit lenders that are mission driven. That is a range where they will, you know, be able to entertain a loan. I can't guarantee that they'll approve a loan, but they're willing to look at a loan if the debt service coverage ratio is between 1 and 1.2. If you're going to a bank or, you know, credit union for a loan, they really want to see the debt service coverage ratio at least 1.2, and some maybe even 1.4. So you really have to be, you know, profitable. The extra 0.2 or 0.4 is just this buffer zone, this wiggle room in case something doesn't happen right. You know, maybe your profits are not going to be as strong. It gives them a little bit more wiggle room to approve the loan. So if you're looking at a community lender, you want to have a debt service coverage ratio of at least 1. If you're looking at a bank, typically 1.2 or higher. And I just want to remind everybody that, you know, these are rule of thumb numbers. Each lender will have their own debt service coverage ratio criteria, and it's based upon how they underwrite the loan, how they structure the loans. So, you know, you could go into a conversation with a banker with a 1.2 ratio thinking that you're, you know, in good shape, when that lender will say, well, based upon your business and your industry, your profile, we really need a debt service coverage ratio of 1.5. So, you know, use this as just kind of a way to estimate what range of profits you'll need or what range of capital that you can provide or seek. So another question that comes into play is, you know, do you look at historical profits or forecasted profits? And again, there's a differentiation between, you know, community lenders and banks and credit unions or for-profit lenders. Banks and credit unions, historically, they want to see steady or growing profits, and the most recent year typically needs to approach that 1.2 or 120% ratio. And your forecasted profits have to start at least 120% and hopefully grow over time. Community lenders, on the other hand, they may not place as much emphasis on historical. Again, they're mission-based lenders, and you know, they want to support businesses that may not be able to secure traditional bank loans, and they know that young businesses may not have the history of profits necessary to get a bank loan, so they're willing to perhaps pay not so much attention to historical, but they need to demonstrate the ability to repay. So their forecasted profits must be 1 or 1.2 and higher. So even if you're a young business and you don't have, you know, too much historical profits, you know, it's very important for you to put together a strong forecast showing your profits having the ability to repay the loan. So I'm going to switch over here in a few moments to a spreadsheet. You can download that spreadsheet on your own, and I'll send this out as a link afterwards. If you download it, or if you scan the QR code or click onto that link down there, it's going to show up as an Excel online document, and it won't work. You're going to have to save the document and go, save a file, save as, and then download a copy. And again, I'll email this out to folks. And this this spreadsheet does a back of the envelope ballpark estimate of what you can get in a loan and your ability to repay. And again, it's enough to have an initial conversation to do some scenario planning with a prospective lender. And again, remember, every lender will have their own underwriting standards. So, this is just that, first initial step. So let me pull up that spreadsheet here, and we'll quickly walk through it. And I'll share a different screen here. Okay, so you see the spreadsheet here. I try to color code it to make it easy for folks to understand. And there's kind of a general rule, anything that's in green is stuff that you can edit. And then I organize the type of information into 4 or 5 different, colored areas. So the first thing you do with this calculator here, and all the numbers here are just kind of initial numbers, you can obviously replace them as needed. You start with your project budget. This is how much you plan on spending. And, you can organize this, whichever way you want. I broke it down into, these 4 or 5 different categories to kind of help you think through what you may want to include. And so you might be expanding your business. You might have some equipment expenses. You may have to buy some raw materials or supplies. You may want some working capital. You may have some sales and marketing expenses. You may have to pay some labor to do some work. And then there are 5 other categories that you may want to classify some expenses. That's for you to pick what you want to do with that. So it adds up the total amount of budget that you have. And so for this sample project, we're talking about $52,000, $52,500 as your total project budget. And then you look at other funding sources that you may be able to contribute. Maybe you have $5,000 in a business that you can contribute, or maybe you have $5,000 of your own money that you want to contribute to this project. It's always very important. Lenders like it when you're able to contribute some capital to the project because it shows that you have some skin in the game. But it's optional. So in this case here, I say I have about $5,000 that I can contribute, which means now that the loan amount that I'm seeking is $47,500. We're going to assume an interest rate of about 9%. That's roughly ballpark these days. Again, it might be higher, it might be lower, but you can start there with the interest rate. And then you see here, it automatically calculates, so just an example here, if I were able to put in $10,000, you'll see all the numbers shift down because I'm borrowing less money. So this spreadsheet will automatically calculate your monthly payment if you had a 2-year loan, a 3-year loan, a 4-year loan, or a 5-year loan. And at this point, you can kind of pick what you think is reasonable for a loan. Now, a lender may not offer you that term, but for this first pass, you can say, I can afford $1,058 a month. So I'm going to pick a 4-year loan. So you click 4 years loan, and it does the calculations. Then it says, okay, for you to support a 4-year loan of $42,500, you're going to minimal required profits of $15,235. And this is assuming a typical 1.2 debt service coverage ratio. So when you look at your forecasts, or as you develop your forecast, you want to be able to show that you're at least generating $15,235 of profit every year. Now, if you go back to your forecast and it's like, oh, this is a little bit low, $15,000 in profit is a little bit aggressive, then you can, one easy thing you can do is just, lower your budget, and maybe say, oh, okay, I'm going to cut out the contractor, take that out. You see now that the total annual required profits becomes $12,052. And so this is an iterative process. You'll go back and forth between your forecast and your project budget until you can finally settle in on a number that meets your kind of investment needs, but also meets your profit forecast. And so when you settle in this sweet spot, then you can go back, start having a conversation with the lender and tell them, hey, I'm, seeking to expand my business in a certain way. And I need, I'm looking for about $35,000 in capital in a loan. And they'll ask you for some kind of forecast, and you're going to say, well, I'm anticipating, my profits will be $14,000 a year. It's a little bit higher than 1.2. Be optimistic about that. And they'll come back and say, okay, this is doable, or they'll say, it's a little bit tight, maybe can you do this, you do this, so you kind of revisit the numbers. But at least it gives you a range where you can start working with. It's not like you go to a lender and say, I need $100,000, and they look at your numbers and they immediately say no because your forecast can't generate that profit. This is a sweet spot. 35,000 can investment in your business, can grow it in a capacity that you think is beneficial, and it is also going to yield sufficient profits for you to repay the loan. And then down here I just have some scenarios here. For a 4-year $35,000 loan, your business must forecast at least this profits for each of the 4 years. And if this is too high, you can consider reducing the interest rate. Now, you don't have any control around that, but you might say, if you think, oh, in a year from now, I think the interest rates are going to be lower, you can factor that out and maybe plan for a lower loan next year. You can increase the loan duration. So, by increasing it to 5 years, the profits requirements go down, but, you're going to be paying more in interest expense, but it might give you sufficient cash flow to pay the loan. And keep in mind that the lenders might dictate what this loan duration, might be. You can, we talked about decreasing your project budget, or you can increase your own contribution of funds into that so that you're borrowing less. And then, as I said earlier, just revisiting your business plan and forecast to see how you can cover, make the changes to make the numbers work. So all this is, all around making the debt service coverage ratio, down to around 1.2.